This video is going to be on internal controls. Internal controls basically are procedures we put in place to prevent errors and fraud from happening. According to the Committee on Sponsoring Organizations, or what is referred to as COSO, internal control is a process effected by an entity's board of directors, management, and other personnel, designed to provide reasonable assurance regarding the achievement of objectives relating to operations, reporting, and compliance. And the COSO cube is one of the more frequently referred to diagrams of internal controls and the need for them within the business environment. Within the COSO cube, you have different layers. You have the control environment, risk assessment, control activities, information and communication, and monitoring activities. Now, in other courses, you might dive into this cube at much greater length. Here, I just wanted to point it out to you to show you that this cube is often one of the things that companies look at in terms of planning and strategizing the different ways that they have to do internal control throughout their organization at all the different levels. The control activities are the specific things that are put in place to prevent fraud and errors from happening. The mission of the Committee on Sponsoring Organizations, or COSO, is to provide thought leadership through the development of comprehensive frameworks and guidance on enterprise risk management, internal control, and fraud deterrence, designed to improve organizational performance and governance and to reduce the extent of fraud in organizations. A little bit of history. COSO was organized in 1985 to sponsor the National Commission on Fraudulent Financial Reporting, an independent private sector initiative that studied the causal factors that can lead to fraudulent financial reporting. It also developed recommendations for public companies and their independent auditors, for the SEC and other regulators, and for educational institutions. Now, which organizations sponsored this? Well, the sponsoring organizations still exist today. They are the American Accounting Association, which is basically the academic accountants, the American Institute of Certified Public Accountants, the Financial Executives International, the Institute of Management Accountants, and the Institute of Internal Auditors. The most important control activities involve segregation of duties, proper authorization of transactions and activities, appropriate documentation and records, safeguarding of assets and records, and independent verification. Our focus here in this video is going to be on safeguarding assets and records. What is fraud? Fraud is wrongful or criminal deception intended to result in financial or personal gain. When we talk about fraud, we normally refer to the fraud triangle. The fraud triangle represents the three things that are present in almost every single fraud case. The first thing is incentive. Why the person is committing the fraud in the first place, whether it's greed or a desperate need for additional funds due to big debt or life situations that they can't handle and they need money to feed their habits, or there's always some incentive. Then we have opportunity. Fraud cannot be committed unless there was an opportunity for the person to commit the fraud. So there's always an opportunity present. And then rationalization, which is why the person thinks that it's okay that they did this. What rationalization did they tell themselves as they were doing it? So with that in mind, the one thing that we can try to prevent with controls is opportunity. But there are different kinds of fraud. There's what we call corruption, the use of position for personal gain. There's what we call misappropriation of assets, which is theft or embezzlement. And then third, there is the financial statement fraud, where we misreport financial statement information for the purpose of making ourselves look better. Our focus here in this video, again, is going to be on misappropriation of assets. Now, let's look at some dictionary definitions. Pulled in some dictionary stuff here. When we talk about theft, we're talking about the action or crime of stealing. Embezzlement is theft or misappropriation of funds placed in one's trust or belonging to one's employer. So if we are taking money, stealing money, we are committing theft. If we are taking it from our employer, then it's referred to as embezzlement. What is larceny? Larceny is theft of personal property. You can have what is called grand larceny or petty larceny. And the difference basically is how much the value of the items are. And depending on where you are, depending on different states, different countries, the difference between these two can be different. Grand larceny, in many U.S. states and formerly in Britain, the theft of personal property having a value above a legally specified amount. So that amount is dependent upon the state, dependent upon the country, but usually it's a legally specified amount. So when we talk about safeguarding assets and records, specifically here we're talking about inventory and equipment, there are some common methods. Unconcealed larceny or theft. This is when employees simply just take inventory or pieces of equipment without attempting to falsify any documentation or cover their tracks. And this is the most common. Now, again, the dollar value impact of this likely is not as significant as some other kinds of fraud, but it is the most common type of fraud. Employees simply walk off with stuff that their business did not necessarily give them permission to take, or they simply steal things that are for sale in the store. Falsified receiving reports. Items come into the business, and when they come in, if I'm the receiving person, I would take one of the items or some of the items, and then I would report that a fewer or a lower amount of items were actually received than were received in reality. Fraudulent shipments or sales, when we change shipping documents to have items sent to some place that they're not supposed to be sent to, or if we have them sent to an accomplice, or we fail to record a sale while giving items to an accomplice. So someone organizes that our friend comes into the store and we give them the items that they are supposed to pay for, and we act like we charged them, but we didn't, and we let them walk out. And then fraudulent write-offs. We change the inventory records to account for stolen inventory or equipment. Now, according to the AIPB, the American Institute of Professional Bookkeepers, the greatest danger that a company faces in the theft of inventory is having no centralized department for receiving and storing merchandise. So if we don't have a process for stuff to be stored and protected, received when it comes in, if we don't have specific procedures in place on how all of that is handled, then we run a pretty significant risk of stuff walking off on its own without our permission. There are 5 internal controls for preventing the theft of inventory. Proper documentation, establishing a system of storing and counting inventory, segregated duties, physical safeguards, and analytical reviews. Now, these are the 5 internal controls that the AIPB says should be put in place. Now, when we talk about proper documentation, this example we're going to walk through actually covers a couple different aspects of control, but we're looking at documentation here first. So, employees in the store realize that they need more of a particular item. Employees are not allowed to order the items in a good control environment. The employees instead requisition that items be purchased by the purchasing agent or purchasing manager. This person is responsible for ordering all of the items for the store. The purchasing agent will send a purchase order to the vendor or supplier from which we purchase these items. And then hopefully the supplier will send the items to our store. When those items arrive at the store, the receiving department, the people who are responsible for receiving the merchandise, hopefully not the people that are stocking the shelves, but the receiving department is going to receive the items. Then they will fill out a receiving report saying, here's the items that we received. The supplier or vendor also will send an invoice or a bill. The invoice or bill comes to the company and should be provided to the accountant or bookkeeper, whoever's responsible for making payments. So what does this accountant do then? This accountant simply will not just pay the invoice straight out. Because before we make a payment, we want to know what we ordered, we want to know what we received, and we want to know what we're being billed for. So the accountant is going to perform a control with documentation. This control is called the three-way match. The three-way match is matching the purchase order, the invoice, and the receiving report. If what we received is what we ordered, and if what we are being billed for is what we received, then we can write a check and we can send out payment. But if there is a discrepancy between any of these items, any of these documents, then we would question and research, investigate to figure out why before we make a payment. So we have to have proper documentation in regard to our inventory. Now we need a system for storing and counting inventory as well. Inventory must be physically counted on a periodic basis in order to verify either the periodic or perpetual records. Companies must have clear procedures for employees regarding how inventory is to be counted and ways to check employees' work once it is done. So we have to have some segregation of duties as well. And typically, we hope and strive for separating or segregating those who have custody of our assets and those who have responsibility for keeping the records. In our example, the employees stocking the shelves and the receiving department personnel, they are the ones that have custody of the assets. They're the ones that physically handle the inventory. While the purchasing manager and the accountant do the record keeping. The record keeping function should not be combined with custody. We're going to see in a few minutes where this can lead to really bad situations. Now, you may have a small business that doesn't have enough people to separate all of these things. And if that's the case, then we need to put in some mitigating controls to try to prevent anything bad from happening. We also have to have physical safeguards. We have to have things like cash registers. We're not going to simply put the money to give customers change with in a shoebox on the counter, right? We're going to put it in a cash register. A cash register for which employees have to have access, right? Random person can't log into the cash register or shouldn't be able to. We need to have safes. Once the day is done and the cash has been collected, it needs to go somewhere before it goes to the bank. We need to have a place to put it where it's protected from fires and theft. And then finally, if there are areas in our business that only certain people should get to, whether that's the inventory storehouse or other places, we need to have a security system of some kind. Now, those are all controls we're going to put in place, but we're also going to do some review of our accounting records to see if we can spot any anomalies that might make us question what's going on. So here we have an analytical review, or we're going to perform an analytical review of this information. So for 2021, 2020, 2019, 2018, I have information here on a corporation. This is purely made up, but we have sales, cost of goods sold, and gross profit. And so looking at the gross profit figures, the dollar values don't seem to change too much over these 4 years. But as we look at the gross profit percentage, what do we see happening? We started with a gross profit percentage of 60% 2018, 60% 2019, 58% in 2020, and 44% in 2021. That's a pretty significant drop in our profit margin. Now, what might be happening? I'm not sure, but this could indicate, right, that something's off with our cost of goods sold. And cost of goods sold, again, is the expense account that's associated with our inventory. So if cost of goods sold is a much higher percentage of our sales than it was before, we want to know why. Why is that the case? So we need to perform reviews like this. It might not mean that fraud is taking place, but it could. Another thing we want to look at is inventory turnover. The inventory turnover ratio tells us how many times we move out of our business, so on to customers. How many times we move our average inventory balance during the year. So in 2018, we moved our average inventory balance 4 times. That means we were able to sell our average inventory balance to customers 4 times. 2019 was 4 times. 2020, it was 4 times. In 2021, it went up to almost 6 times. So that looks great, but we may want to look at why this significant change happened. It doesn't look consistent with previous years. And if we don't know anything out of the ordinary from previous years, a big change like that is kind of a red flag that something's up. And then looking at the cost per unit. Well, the cost per unit for the first 3 years was hovering around $11.95. But in 2021, the cost per unit dropped to $10.55. Now, if we're not aware of anything that should be changing with regard to the cost per unit of our items, then we should probably investigate this. So analytical reviews are very important. So, how do we detect and prevent employee theft? According to the AIPB, we need to hire the right people first. We should check with our human resources or legal team before doing these things, but these are things we probably should consider doing. Investigating their past employment, contacting their references, conducting or outsourcing a background check, drug screenings, and independently confirmed degrees, certificates. We need to audit the books. Independent verification of records by someone other than the bookkeeper. Particularly important in small company with one person who's keeping the books. So if you're doing the books for a business and you're the only person that handles the books, you should request that your employer provide an audit of the books somehow by hiring somebody outside or having the owner look at them to provide you with some security. And you should think about obtaining insurance. A fidelity bond is insurance against theft or fraud. Now, a fidelity bond typically has a subrogation provision. So what is subrogation? Subrogation is a term describing a legal right held by most insurance carriers to legally pursue a third party that caused an insurance loss to the insured. This is done in order to recover the amount of the claim paid by the insurance carrier to the insured for the loss. When an insurance company pursues a third party for damages, it is said to step into the shoes of the policyholder, and thus will have the same rights and legal standing as the policyholder when seeking compensation for losses. So if somebody steals a bunch of money from your company and you have this insurance, you get paid out, right? You'll get a payment from the insurance company. But then the insurance company takes the right or the prerogative to go after that person and try to reclaim the amount that they had to pay out to you. Now, why do we care about these controls? We care about controls because we want to prevent fraud. Controls will also help us prevent errors from happening, but errors usually aren't as significant in terms of the impact they have on our business as fraud is. The Association of Certified Fraud Examiners is the world's largest anti-fraud organization and premier provider of anti-fraud training and education. Together with more than 85,000 members, the ACFE is reducing business fraud worldwide and inspiring public confidence in the integrity and objectivity within the profession. So the ACFE produces each year a report to the nations. It's a global study on occupational fraud and abuse. So I want to take a minute to show you what that looks like. So this is the report to the nations, the global study for 2018. It's produced by the Association of Certified Fraud Examiners, and it's about 80-some pages long. We're not going to go through all of that, but I just wanted to show you some of the things that are in here. They talk about the cost of occupational fraud, how occupational fraud is committed, detecting, victim organizations, perpetrators. They discuss who are these people who are committing this fraud. And then they have some case studies, and they talk about some different regions within the world. So they have some key findings here right off the bat. Based on their study, there were 2,690 real cases of occupational fraud from 125 countries in 23 industry categories. In total, there were $7 billion in losses. So they have some pretty cool infographics here. They get into some more details as you go. But coming down here to page 11, I want to show you something that's a pretty good diagram in terms of describing fraud. And so they have what's called the fraud tree. They have these three areas of fraud, which we discussed already: corruption, asset misappropriation, and financial statement fraud. And within each of these, they talk about the different kinds. So within asset misappropriation, if we scroll down, we see that they have cash and inventory and other assets. So how do employees steal cash? Well, there's theft of cash on hand, theft of cash receipts, fraudulent disbursements. And then within those, you've got different ways, right, that fraudsters commit fraud. Inventory and other assets, they talk about misuse, and they talk about larceny. And there's different kinds of ways that they do that. So this tree kind of gives you an overall picture of the different kinds of fraud and the different types and strategies that employees might engage in order to commit them. As you keep going, you're going to find tons of other stuff about fraud in the world, about corruption, and all of that kinds of stuff, which is really quite an interesting read if you have time to sift through some of the stuff. So, again, they talk about three different kinds of fraud: corruption, asset misappropriation, and financial statement fraud. Within asset misappropriation, you've got two different kinds, whether it's talking about cash or talking about inventory or other assets. So I want to look at one of those related to the fraud of cash, okay, stealing of cash, theft of cash. Fraudulent disbursements. There are 9 types and 16 ways that cash can be taken. So I'm going to go back to this screen here. So you have theft of cash receipts, and then fraudulent disbursements. So within fraudulent disbursements, you've got 1, 2, 3, 4, 5 different types, and you've got about 16 different ways. So I think I have an error on my slide here. It should be 5 types, 16 ways, but that's okay. One of those ways is check or payment tampering schemes. A fraudulent disbursement scheme in which a person steals his or her employer's funds by intercepting, forging, or altering a check or electronic payment drawn on one of the organization's bank accounts. So, for example, the employee steals blank company checks and makes them out to himself or herself or an accomplice. Employee reroutes an outgoing electronic payment to a vendor to be deposited into his or her own bank account. So these are different check or payment tampering schemes. A couple different ways you can do this: forged maker, forged endorsement, altered payee, authorized maker. So what does forging mean? Okay, the dictionary says that forging is producing a copy or imitation of a document, signature, banknote, or work of art for the purpose of deception and for financial gain, which it doesn't say that, but that's basically why it's done. Now, one of the most interesting movies to watch, if you're interested in film, with regard to check fraud, is Catch Me If You Can. This film is about a seasoned FBI agent who pursues Frank Abagnale Jr., who before his 19th birthday successfully forged millions of dollars worth of checks while posing as a Pan Am pilot, a doctor, and a legal prosecutor. He's a real guy. This is a picture of Frank Abagnale Jr., and he served time in France, Sweden, and the United States for his crimes. Abagnale was eventually granted parole after several years. He eventually found lecturing work as a white-collar crime specialist, providing information to bank employees about ways to avoid fraud and theft. In exchange for his freedom, the government told Abagnale that he had to educate them about his methods in order to prevent others from defrauding authorities. So Abagnale worked with the FBI for more than 30 years as one of the world's foremost experts on document fraud, check swindling, forgery, and embezzlement. He also started his own company, Abagnale and Associates, which educates others on how to avoid becoming fraud victims. So you get a pretty good glimpse of how he did what he did if you watch the movie. It's kind of an older movie, but not really too old. I don't remember when it was made. But it's a good one if you're interested in this kind of stuff. Another one of the fraudulent disbursement schemes is expense reimbursement. A fraudulent disbursement scheme in which an employee makes a claim for reimbursement of fictitious or inflated business expenses. So the employee files fraudulent expense report, claiming personal travel or non-existent meals, etc. So you can mischaracterize expenses, you can overstate expenses, you can put in fictitious expenses, or you can reimburse the same thing more than once in order to swindle the company out of money or embezzle funds. So recently, relatively recently, a book came out called The Assistants. It's a novel, a work of fiction, and it's quite good. There are pieces to it that I don't agree with and pieces to it that I do. But it's about a girl named Tina Fontana, who's 30-year-old executive assistant to Robert Barlow, the CEO of Titan Corporation. It's a multinational media conglomerate. She's excellent at her job and beloved by her famous boss. But after 6 years of making reservations and pouring drinks from bottles that cost more than her rent, the glamour of working for a media company in New York has completely faded. But her student loan debt has not. When a technical error with Robert's expense report presents Tina with the opportunity, again, that's one of the three pieces of the fraud triangle, right? Presents Tina with the opportunity to pay off for the entire balance of her loans with what would essentially be pocket change for her boss, she hesitates. She's always played by the rules, but this would be a life changer. As Tina begins to fall down the rabbit hole of her morally questionable plan, other assistants with crushing debt and fewer scruples approach her to say that they want in. Before she knows it, she's at the forefront of a movement that has implications far beyond what anyone anticipated. And this book is actually quite good. It would be a good read if you're interested in this kind of stuff, but it'd be a good read anyway. It has a lot of timely things about student loan debt and inequality. It also is a good example of opportunity within a business for fraud. And lastly here, why do we care so much about this stuff? We care about this stuff because it really matters and it has an impact on people. So this is an excerpt from a news article. It says, a retired secretary and bookkeeper for the Roanoke Benson School District was sentenced to 8 years in prison Tuesday after admitting stealing almost $1.2 million from her employer over 10 years. Catherine Capone, who reportedly used district checks to pay her own credit cards and other expenses and altered records to cover the embezzlement. Capone used her control over school district checks to pay her personal bills and draw cash, and accounted for those expenses under legitimate budget line items. She then personally picked up bank statements and altered the name on the payee on the canceled checks, changing them to legitimate vendors, before turning the statements over to Marilyn Ott, the district treasurer, for reconciliation. Capone wrote the checks for relatively small amounts that did not exceed the budget line items to which they were charged. The discrepancies were discovered in late February, about a month after Capone retired after 42 years with the district, when her replacement, Cheryl Wacker, noticed irregularities and reported them to Superintendent Ron Peterson. Peterson said the subsequent internal investigation included a review of checks as far back as the district records allowed, to July 1st of 2002. So 2002, 2013 is about 10 years. But she'd been there for 42 years. So who knows what happened before that? Anyway, it says an external police investigation and a forensic audit by Neil Gerber of Heinold-Banwart, who was hired by the district, corroborated the findings. During her time as the district bookkeeper, our annual audit reports did not uncover the situation, Peterson said in a written statement Tuesday. No one suspected that the bank statements were being altered. Peterson also said the district has changed its accounting system to make sure that this type of theft cannot happen again in the future. So, the bookkeeper for the school district had worked there for 42 years, likely one of the most trusted people in that organization, stole or embezzled over $1 million from the school district. Now, why do I pick this particular example? Stealing $1.2 million from a school district is money that could go to books for kids, to meals for kids, to other things for children who are trying to learn. You're stealing from young people. It's a ridiculous thing to think about. But it happens. And it happens because of opportunity. Capone had the opportunity to do this. She had some incentive, whether it was greed or something else, and she had the opportunity. With those two things, you are ripe for fraud. So, why are internal controls important? The median response provided by certified fraud examiners in their study said that organizations lose 5% of their annual revenues to fraud. Now, depending on your company, 5% in terms of dollars might be a small amount, might be a huge amount, but it's a significant thing. The total loss caused by the cases in our study exceeded $7 billion. $7 billion in 2018 lost due to fraud. Fraud not only harms businesses, it harms the employees, customers, and vendors who are connected with the business, as well as the community in which the organization is situated. Accountants and bookkeepers need to understand controls and do their utmost to implement appropriate controls in order to protect both their own reputation and the businesses for whom they work. If you are supremely interested in this kind of stuff, you can become a certified fraud examiner. The Association of Certified Fraud Examiners has a series of exams that you would take, not altogether unlike the American Institute of Professional Bookkeeper certification exams, but the certified fraud examiners possess unique expertise in preventing and detecting fraud and are highly valued by organizations spanning all industries, sectors, and sciences. You can become a CFE, and you can join fraud experts fighting fraud around the world. So, internal controls are extremely important. This is just kind of a high-level overview of what we're talking about and why we care about it.